For a lot of people, investing feels like this big, mysterious black box, right? You put your money in, you cross your fingers, and you just kind of hope for the best. But what's actually happening behind the curtain? Well, it's way more interesting and honestly way more important than you might think. So let's go ahead and crack open that box and see what's really inside. And yeah, this is pretty much how we all start, thinking, I put money in and hope it grows. It's not totally wrong, but man, it misses the whole story. The truth is, your money goes on this incredible journey. And if you understand that journey, that's the key. It's what helps you make smarter moves and stay cool, even when things get a little shaky. Okay, so here's our game plan. First, we're going to talk about the single most important mindset shift. Then, we'll follow your money step by step to see what it's actually doing. We'll look at how it grows. And then we'll tackle the big one, decoding those wild market swings. All right, let's dive into the most important idea of all. This is the foundation. The biggest mistake people make when they're starting out is thinking investing is just like gambling. It's not. They're worlds apart. And the difference comes down to one simple, powerful word: ownership. And this right here is the whole ball game. When you gamble, poof, your money's on the table. It's a bet. But when you invest, you're not betting. You're trading. You're trading your cash for a piece of something real. Your money doesn't just vanish into the ether, it changes its shape. It goes from being cash sitting around to being a piece of a real productive asset. So what kind of stuff can you own? Well, there are stocks. That means you own a tiny little piece of a company. Then you've got ETFs, which are kind of like a bundle deal. You get tiny pieces of lots of different companies all at once. And then there are bonds. With a bond, you're not an owner. You're actually a lender. You're loaning your money out, and in return, you get paid interest. Okay, let's focus on stocks for a second, because they're super common. When you buy a share of a company, you are literally a part owner. You have a real claim on their profits, their buildings, everything. You're not just buying some letters on a screen that wiggle around. No way. You're buying a piece of the actual business. And that's the key takeaway here. Your success is directly tied to the success of that company. All right, so you're ready. You've decided to become an owner. You open up your app and you hit that buy button. It feels like magic, right? Instant. But in that split second, this incredibly complex, high-tech process kicks off in the background. So your order goes on this quick little journey. First, your broker zips it out to a market to find someone selling what you want to buy. Then they get matched up. After that, this big, important company, a clearinghouse, steps in the middle to make sure everything's legit. And finally, the settlement. The shares land in your account, and your cash goes to the seller. Done. And it's kind of amazing when you think about it. Back in the day, this was all paper. Seriously, they called it the paperwork crisis. You had people literally running paper stock certificates around Wall Street. It took days. Now, it's all automated, super fast, and usually happens in just a day or two. It's a completely different world. Okay, let's keep going. Once that trade settles, it's official. You're an owner. And here's the cool part. Your money isn't just sitting there anymore. It's got a job now. It's out there, working in the economy. And that's a huge deal because cash that's just sitting in a bank account, it feels safe, but inflation is quietly eating away at it. Your investment, on the other hand, is now tied directly to economic growth. Now, how your money creates value really depends on what you own. With stocks, it's all about business performance. If the company does well, makes more money, creates cool new stuff, your piece of the pie gets more valuable. Simple as that. Bonds are a different story. Remember, you're the lender, so you make money by getting paid back with interest. It's a steady, predictable income. And that predictable payment from a bond has a cool old school name: a coupon. It's a leftover from when bonds were actual pieces of paper, and you had to physically clip off a little coupon and mail it in to get paid. So yeah, if you have a $1,000 bond with a 4% coupon, that means you're getting $40 a year. Nice and simple. So what's the actual job your money is doing? Well, it's funding everything. It's helping companies build new factories, hire more employees, invent the next big thing, all that stuff. When you invest, you're literally providing the fuel that powers the engine of the economy. Your money has gone from passive to productive. Okay, now we get to the part that feels like magic. It's not, but it sure feels like it. Once your money is out there working, it can start to do this incredible thing called compounding. And the secret ingredient is time. So what is compounding? The simplest way to think about it is your money starts making its own money. Think of a snowball rolling downhill. When you get paid a dividend from a stock or interest from a bond, you can either pocket the cash or, and this is the key, you can reinvest it. That's like packing more snow onto the snowball. It's how you get that compounding engine fired up. Let's put some numbers on it to make it super clear. Say you invest 10 grand and you get a 6% return. That's 600 bucks. Great. Now you reinvest it. So the next year, you're starting with $10,600. If you earn 6% again, you don't make $600, you make $636. And that extra 36 bucks, that's the magic. It's not new money from your pocket. It's your earnings earning their own earnings. That's the snowball starting to roll. And that tiny little effect, it becomes a giant over time. Just look at this, a one-time investment of $6,000. See how the growth isn't a straight line? It curves up and it gets steeper and steeper. The growth between year 20 and year 30 is way bigger than the growth in the first 10 years. Why? Because you're making money on top of a much bigger pile of money. Time is everything. Okay, so this brings us to the last piece of the puzzle, and honestly, this is the one that trips up almost everyone when they're new to this. Why on earth do the numbers bounce around like a yo-yo every single day? A lot of us look at the market like it's a report card on our life decisions. Green day? Yes, I'm a genius. Red day? Oh no, I'm an idiot. That mindset will drive you crazy. A real investor knows the market isn't a scoreboard. It's a pricing machine. A massive, chaotic, super fast machine that's just constantly trying to figure out what something is worth based on a flood of information, news, and straight-up human emotion. And this is what leads to that classic head-scratching moment we've all had. You see a company announced amazing, record-breaking profits, and the stock price tanks. You just stare at the screen and think, what? How is that even possible? It feels totally backwards. And here's the answer. You have to separate short-term price from long-term value. In the short term, the price is all about hype, fear, and expectations. It's just noise. So maybe those record profits were great, but they weren't quite as ridiculously great as some analysts hoped they would be. So the price drops. But over the long haul, all that noise cancels out, and the price will eventually catch up to the real value the business is creating. This is so important. It's the difference between volatility and real risk. Volatility is just the choppy waves on the surface of the ocean. It's the price you pay to be on the boat. It's not the same as the boat sinking. A real permanent loss? That only happens if you invest in a company that actually goes bankrupt. Or, and this is the big one, you panic during a storm and jump overboard by selling at the worst possible time. So let's wrap it all up with this. The real risk in investing isn't a bad day in the market or some scary news story. The real risk is not understanding what you actually own. So I want you to ask yourself this. When you look at your account, what do you see? Do you see a bunch of flickering numbers that make you feel good or bad? Or do you see what it really is? Your personal stake in a collection of actual businesses working and growing in the real world? Because believe me, the answer to that question, that changes absolutely everything.